Put the spotlight on a corporate conversation on the back of earnings. We've got the management of Dilip Buildcon joining us on the show. We've got Mr. Rohan Suryavanshi, pardon me, the head of strategy and planning at Dilip Buildcon. Before we start the conversation, just want to take you through what these numbers look like, slightly on the softer side for the first quarter. Revenue looking good. There's been a degrowth of 9.3%, but continues to be ahead of estimates. The net profit has come in at 113 crore rupees, which is down about 51% on a year-on-year basis. The EBITDA is also down 17.5%, and we've seen a slight bit of a contraction coming in on the EBITDA margin front as well. Just trying to understand what is the outlook going ahead. Let's take the conversation ahead. Mr. Suryavanshi, hi, good afternoon, and thanks for your time. Give us a sense of how the first quarter has been for you, and going ahead, what's a sustainable margin number that you're seeing? Any visibility on margins crossing 20%?
Hi, first of all, thank you for having me on your show. So the quarter first that in the construction sector is usually a quarter that runs kind of softer than the quarter four, but the real revenue in our sector comes in quarter three and quarter four. So quarter two will be softer because it's the rainfall sort of quarter as well. But our full year guidance, our full year sort of outlook remains very optimistic, and we've already guided the market towards a 30-40% top line growth. And the EBITDA range that we mentioned is a 10 to 12% EBITDA. So we're very confident about all of that being met, because we have a very healthy order book currently in hand, and it's a very diversified order book. So all the orders that we'd won last year, they will start throwing revenue in quarter three and quarter four.
Rohan, hi, this is Harsh. So I'm trying to therefore get a sense, how is order flows panning out for you? How strong are order flows? Are we seeing an increase at all? And how's order winning playing out? What's the L1 pipeline? How much do you intend to win?
Hi, Harsh. Or the first half of the financial year is typically softer in terms of the order flow. The orders usually come in the second half of the financial year. That's been the trend for the last many, many years. The order pipeline, I'm happy to report, is extremely robust. Currently, we are in the process of evaluating about 2.5 lakh crores of orders, out of which about 1,30,000 crores are in the road sector, and about another 1,20,000 crores are in the other sectors that we operate in. So it's a healthy pipeline that we're looking for. And even in this year, we've already won orders of about 3,000 crores already. And our full year guidance for this year was about 10-12,000 crores. So we're very confident that we will achieve that number.
And typically, when you win these orders, Rohan, is there a pass-through with regard to raw material costs? Because those would have likely climbed. There were also certain labor issues which got faced by some industries in Q1. Did you face those as well? Anything in terms of that topic which you can throw some light on?
So there is not a complete pass-through of costs, especially when the costs run up in such a sudden manner as what we saw, what happened post the US and the Iran sort of crisis. There was a sudden jump in all raw materials, and obviously our contracts do not absorb all of it. So some of it is obviously the companies had to absorb. On some part, the governments have assured that they will try to do what they can. But the short answer, it's not a completely absorbing. It's not something that's completely absorbed in the government contracts. Going forward, as we see that this situation kind of wanes down a little, I think we should expect a more normalized margin profile going forward.
Okay, and lastly, just want to get a sense on your debt picture. You have guided to become net debt positive by FY28. Are you on track for that?
Absolutely. We have guided the markets towards that. And had we not been investing in our assets in the last 2 years, so DBL from its own balance sheet has invested about 1,200 crores plus in building an asset portfolio, assets which we are now going to be transferring into the InvIT. Of all the investments that we've made, we will be holding about 3,000 crore plus of InvIT units, which will provide long-term cash flow visibility for the company. Even right now, I'm also happy to report that we had won some solar projects and we had won some transmission projects, both of which we are now looking to divest to Alpha Alternatives, our partner with whom we had set up our InvIT. So there is a constant capital recycling exercise that's happening, plus the new orders and the profits that we'll get from them. All of them will kind of help us in achieving our debt reduction goals. So on a standalone basis, I'm fairly confident that we'll be a near net debt zero company in the next 2 years.
Last off, Rohan, just very quickly. So the fact that margins might take a knock, just given the way raw material prices have moved, does that bother you? Does that probably, in some form or shape, leave you cautious with regard to your full year FY27 guidance for margins?
I don't think there should be a meaningful erosion of margins, because this is a temporary scenario, and for me to kind of imagine that it'll continue for a year and all these prices will remain elevated is slightly difficult, and I'm not the best person to kind of judge that. But based on whatever we've seen happen in the last quarter, I think the more realistic estimate is that all of these situations should kind of normalize, and we should see a more normalized margin profile going forward. And along with that, like I said, some support from the government would also help in keeping things sane for the whole industry.
Rohan, thank you so much for joining us and giving us that perspective. We'll let you go.
Thank you very much.
Thank you. Okay, we'll submit a very short break, come back, plenty to speak about. Stay with us.